everybody, it's John King with Summit Funding, and I just wanted to reach out to you today with some fantastic news from the underwriting world. Common sense is back in certain aspects of underwriting. Let me say that again. Common sense is back in certain aspects of underwriting. Recently, Fannie Mae came out with an announcement that had multiple policy changes. 3 of them have huge implications to our industry and how we calculate and document paperwork for our clients. So I'm going to cover very quickly what those 3 changes are. First and foremost is that Fannie Mae said we don't have to worry about over-documenting income reduction for people who have unreimbursed employee business expenses. Very simply, they're saying that unless you're a commissioned employee, we don't have to worry about expenses that you have on the job. Just like we don't worry about what you spend for food, what you spend for gasoline, what you spend for clothing, we also now don't have to worry about what you spend for on-the-job tools. This is important for people such as teachers, because teachers, unfortunately, with the state of our system, don't have enough supplies to take care of their students, so they spend money out of pocket for those supplies. It's true for nurses or other professionals that have to pay for union dues or that have to pay for uniforms. We no longer have to account for those expenses as a reduction of their income. That has huge implications. This is only available for conventional Fannie Mae loans. It is possible that this could apply to other loans down the road, but right now it's only for conventional Fannie Mae. Change number 2, simple but big implications. We no longer have to reduce somebody's assets just because it happens to be a retirement account or it happens to be a stock or bond. What really has been happening here is that if somebody has $100,000 in a mutual fund, we only got to count $70,000 of that account because we were worried about market fluctuations. Well, the reality is there's really $100,000 in that account right now. So Fannie Mae says, you know what, you can use the entire balance of what is in that account to count towards down payment money, or more importantly, towards reserves, which is money that's required to be left over after somebody purchases the home. So very, very big implications, and that's going to help a lot more people qualify for homes. The third change, probably the biggest change, is Fannie Mae removed the departing residence rule. Very simply, going back to the mortgage meltdown, there were a lot of people who were doing what's called buy and bail. They'd purchase a new home and they'd bail out on the home that they previously owned because, hey, you can get a brand new house or a new house to you for a lower mortgage and a lower interest rate compared to what you owed on the home that you owned at the time. So Fannie Mae wanted to combat that, so they came out with a rule, so did Freddie Mac, that said if you don't have at least 30% equity in the property, you cannot count rental income from the property that you're moving out of, that you're converting to a rental property. So that was their way of saying, look, unless you have a lot of equity in the house, we're worried that you're going to walk away. Even if you did plan on having a tenant in there, it's possible that tenant may move out. And you have vacancy for a month or 2, and we want to make sure that you can afford to make the monthly payment every single month, even if you didn't have a tenant in there. That's the old rule. The new rule for Fannie Mae says we follow normal guidelines. We don't care how much equity you have on the property. We can count rental income from that property. It is great news that Fannie Mae is reacting to the fact that the market cycle has changed. We are back in a cycle where mortgage loan quality has improved dramatically. Housing prices are going up. And so we're not in the same cycle of people letting homes go like they did before. And so they're allowing some relaxation in the guidelines and allowing some common sense to get back into lending. Now, one of the things you need to be aware of here is something called overlays. So if you're dealing with a mortgage bank that does not have a direct relationship with Fannie Mae, they may not be able to take into account these new guideline changes because a lot of the big banks say, we just feel safe keeping these policies in place. So Summit Funding is a direct mortgage bank. We sell directly to Fannie Mae, therefore we make the decision ourselves, and we're not subject to the overlays of the national banks. So if you have any questions, please give us a call. Look forward to helping you out and have a wonderful day. Bye-bye.